Hello, I'm Don. Today I'm doing a full balanced comparison between two asset classes everyone's talking about, gold and Bitcoin. This video is for anyone who wants to know where to put their money, how to manage risk, and what the real differences are between these two. I'll use data, history, and realistic scenarios. This is not financial advice. Stay until the end, because I'll give 3 practical allocation scenarios and a short-term recommendation you can test. 0-0. Introduction and Overview. 130. Roots and Nature of Gold. 330. Roots and Nature of Bitcoin. 530. Fundamentals, Supply, Demand, and Drivers. 730. Price Behavior and Market Psychology. 830. Liquidity and Access for Gold and Bitcoin. 1030. Main risks for each asset. 1230. Historical Returns Overview. 1330. Taxes, Custody, and Hidden Costs, U.S. Context. 3 practical investment scenarios. 1630. Numerical example and risk rules. 1730. Psychology and behavior tips. 1830. Bitcoin is often called digital gold, but its nature and price behavior are very different from physical gold. Bitcoin is fast, fully digital, and highly dependent on technological adoption, regulation, and crypto market liquidity. In one sentence, gold is a physical commodity with long-term value. Bitcoin is a young digital asset with high volatility and high growth potential, but also unique risks. Now let's compare fundamentals: supply, demand, and drivers. Supply-wise, gold has a relatively predictable annual production from mines and central bank reserves exist. Bitcoin supply is fixed and released by the protocol through mining and halvings. This difference in supply nature matters. Gold is a commodity with marginal extraction costs, while Bitcoin is a protocol with a deterministic issuance schedule. On the demand side, gold has real industrial and jewelry demand alongside investment demand. Bitcoin's demand is mostly investment and speculative at this point, with limited re. Here are 3 practical investment scenarios you can use according to your risk tolerance. Scenario A, conservative. Target capital preservation and inflation protection. Allocate 80% to gold physical or gold ETFs and 20% to short-term cash or short-term bonds. Low volatility, suitable for retirement or emergency capital. Scenario B, balanced. Target steady growth with exposure to upside. Allocate 50% to gold, 30% to cash or short-duration bonds, and 20% to Bitcoin or crypto. Reduce position sizes in crypto to manage volatility. Scenario C, aggressive/speculative. Target high growth and accept large drawdowns. Allocate 20% to gold, 10% to cash, and 70% to Bitcoin and altcoins. This is a high-risk portfolio, and you must enforce strict exit rules and stop losses. Always keep an emergency cash reserve separate from these scenarios. Now, a simple numerical example for the balanced scenario using a hypothetical starting capital of 100 million in local currency. That becomes 50 million. Here are 3 practical